All right, welcome. Today we're going to build a really powerful way to think about investing in precious metals. We're going to map out Sprott's entire lineup of products onto a risk pyramid. This will give you a super clear framework to pick the right investment, from the super safe stuff all the way to the high-risk, high-reward plays.
Okay, so let's just dive right in. This is really the first question every investor has to ask themselves. Do you want to own the cold, hard metal itself, or do you want to own the companies that are actually pulling it out of the earth? And believe me, they are two totally different ways to play the same game.
So on one side, you've got the physical metal. That's direct ownership, right? It's a real, tangible asset. No company drama involved. But on the other side, you've got mining stocks. And the key word here is leverage. This means their stock price can move way more dramatically, both up and down, than the price of the metal itself.
So here's how we're going to tackle this. Think of it like we're climbing a pyramid. We'll start at the solid foundation, then move up to the established players. We'll climb to the speculative peak, check out some specialized tools, and then we'll put it all together so you know exactly which tool to use and when.
All right, let's start at the bottom, the foundation of our pyramid. This whole level is about one thing: preserving your wealth. It's about direct ownership, the real bedrock of any solid precious metal strategy.
First up, Fizz. Now this isn't some paper promise or a futures contract. Nope. Fizz is all about giving you direct exposure to the price of gold because it holds the actual gold bars. Fully allocated, locked up in a secure vault. I mean, it's pretty much as close as you can get to owning the gold yourself without, sticking it under your mattress.
So who is this for?
Well, it's for anyone whose main goal is just to protect their purchasing power from getting eaten away by inflation. It's also for the skeptic, the person who wants zero counterparty risk. You're not worried about a bank or an exchange going under. And hey, for investors in the US, there can be some nice potential tax advantages compared to other gold ETFs.
And for silver? Well, you've got PSLV. It works on the exact same principle as Fizz. It's pure, direct exposure to physical silver, holding those big London good delivery bars. Again, no funny business, no derivatives, just the metal itself.
Okay, so this is really important. When does this foundation level really shine? These physical trusts, they're built for times of economic stress. We're talking high inflation, that nasty stagflation combo, where nothing's growing but prices are, or, a full-on currency crisis, where people are losing faith in regular money.
But what if you can't decide, gold or silver? Well, that's where CEF comes in, the Sprott Physical Gold and Silver Trust. Think of it as your one-stop shop. It blends the stability of gold with that higher growth potential you get from silver, all in one easy ticker.
Okay, let's climb up to the next level of the pyramid. Now we're introducing that concept we talked about, leverage. And we get that through the miners. This is where a company's profits can just blow past the moves in the metal price itself. We'll start with the big guys, the establishment.
So this chart really explains that whole leverage idea perfectly. See, if the price of gold goes up, say, 10%, a miner's revenue doesn't just go up 10%, because their big costs, like the mine itself, are mostly fixed. All that extra money from the higher gold price can drop straight to the bottom line. It can have a huge, outsized impact on their profits and their stock price. That's the big appeal of investing in miners. And SGDM is Sprott's way to play this. It's an ETF that focuses on the establishment. The big, mature gold producers that are already pumping out cash. These are basically the household names in the mining world.
But here's the thing. SGDM isn't just buying the biggest companies. No, it's what they call a factor-based ETF. It actively screens for companies that are financially healthy, is looking for things like strong revenue growth, tons of free cash flow, and really low debt. It's a quality-first approach to the big miners.
All right, time to head to the top of the pyramid. This is the pointy end, the speculative peak. We're talking about the junior miners. And this is where you'll find the absolute highest risk, but also the highest potential for some truly explosive returns. And this is the home turf of SGDJ, the Sprott Junior Gold Miners ETF. This one targets the little guys, the small cap companies, the explorers, the developers. These are the teams out there trying to find the next giant gold deposit, or maybe just hoping a bigger company will come along and buy them out.
And this right here shows you the difference in strategy perfectly. So SGDM, the senior miner fund, that's all about proven financial quality, right? But the junior fund, SGDJ, it's looking for completely different things like price momentum and revenue growth. It's really the difference between buying a solid, stable business versus betting on massive future potential. So when do these junior stocks really have their moment? Well, they tend to do best late in a big bull market for precious metals. That's when investor sentiment shifts from being cautious to just plain greedy. They also do great during M&A cycles. That's when the big miners go on a shopping spree, snapping up smaller companies to get their hands on their gold deposits.
Okay, before we wrap this all up, let's just quickly touch on two special funds that kind of sit between these layers we've built. They offer some really unique ways to invest. First up, we have the SLVR ETF. What's really cool here is its hybrid setup. Most of it, about 80%, is invested in a bunch of silver mining stocks. But, and this is the key part, it also holds a big chunk, around 20%, in actual physical silver. That physical cushion is there to try and smooth out some of the crazy volatility you can get with mining stocks.
And then there's GBU. This one's an actively managed fund. So instead of just following an index, you actually have real people, portfolio managers, who are hand-picking which gold and silver stocks to buy. The whole idea is that the mining world is full of potential problems, right? So, the thinking goes, an expert manager can hopefully beat the market, generate that alpha, by knowing which bad apples to avoid.
So after all that, how do you actually use this pyramid? Well, it really just comes down to matching the right tool with your own tolerance for risk and, maybe most importantly, what you think is going to happen in the market.
Think of this table as your ultimate cheat sheet for this whole framework. You've got the defensive physical trusts for when inflation is a problem, the senior miners for when a bull market is just getting started, and the aggressive juniors for when things get really heated and greed takes over. It's everything we've talked about all in one spot.
So what's the big takeaway here? It's this. Use this risk pyramid as a mental model. It forces you to decide, do you need that solid foundation for preserving wealth with physical metal? Or maybe a tool for more conservative growth with the senior miners? Or are you looking to add that speculative peak with juniors for some really aggressive returns?
And that really brings us to the final question you need to ask yourself. Take a look at everything that's happening today. Inflation, what interest rates are doing, all the geopolitical stuff. And just ask, where on this pyramid do you belong right now?